Okay, so picking up where we left off, we're now going to use the accounting equation to analyze transactions. And this is the first step in a process that we'll continue with next chapter. So in accounting, we use what's called the double entry accounting system, which means every transaction will affect at least two things. For instance, let's say you bought a car and you paid cash. So what went out was cash, that's what you gave up. What came in was the car. And so there's two sides to this. So we have to kind of keep it in balance. And so our accounting equation is assets equal liabilities plus owner's equity. So we'll keep that in mind. And so when we analyze transactions, the first couple steps, the first step is to identify which accounts are affected by this transaction. What we're really doing, in a lot of ways, accounting is like a foreign language. And so we're translating from English to accounting. So which accounts are affected and what type of account those are. Type of account. After we do that, I'm going to go through the first three steps and then we'll use a couple examples. Then we decide if each account is increasing or decreasing. Account is increasing or decreasing, and then we look and see if the accounting equation is still in balance. If the accounting equation is still in balance. So back to this side, it's an equation, so the left side still has to equal the right side no matter what we did. So for example, let's say I paid my rent $500. So that's how we say it in English, right? So step one, which accounts are affected? Now this at first will be, this will be a little bit tougher. At first we'll have to go through these kind of slowly, but after a while you kind of get used to these. And if you worked for a company, you would have a chart of accounts that would tell you which the account names are. But for this one we'll say I paid my rent. So which accounts are affected? Well, if I paid something, I paid cash, so that's going to be affected. And the other thing, what I paid was rent. So this will be a rent expense, for example. Which is part of, so then we say which type of account. Cash is an asset, right? And rent expense is part of owner's equity. So the second part we do is determine if they are increasing or decreasing. So if I paid something, cash is decreasing, that's going down. And if I have an expense, if we go all the way back to, let's slip back here, we said expenses decrease owner's equity. So owner's equity is going down with this expense. So owner's equity is going down. And so the third thing, am I still in balance? So assets equal liabilities plus owner's equity. Assets went down by 500. Owner's equity went down by 500. And liabilities was not affected by this. And so I'm still in balance. So both sides went down by 500. There's some transactions, it doesn't have to be one side of the equation or the other. There's some where one asset went up and one asset went down, but they kind of offset each other, so the total equation is still in balance. So let's look at a couple of these. This is in 1-9, and this is in the practice problems. So we'll just write assets equal liabilities plus owner's equity up here. So for each one, we're just going to kind of look at which account, where I want to do which accounts are affected, what type of account it is, and if it's going up or down. So for the first transaction, I received cash for service revenue earned. So which accounts are affected? We've got cash right here, and we see we've got revenue. So those are the two accounts. Cash is an asset, and revenue is part of the equity account. And we received cash, so cash went up, and revenue adds to owner's equity, so owner's equity went up. And so we can see that both sides of the accounting equation went up by $520, so I'm still in balance. Paid $325 for salary expense. So as soon as I see paid, I know that I've got cash, and this has the word expense right in here, so I have the account. So this would really be, the account would be service revenue. This will be salary expense. Cash is an asset, and salary expense is part of owner's equity. I paid cash, so cash went down, and if I have an expense, owner's equity went down. So the accounting equation is still in balance. Max Dale, the owner, contributes $1,000 to the business in exchange for capital. So the business is gaining cash. All right, that's an asset, and that's going up. And then capital is part of owner's equity. And so that's something that adds to owner's equity, so that is going up as well. Both sides went up by $1,000. The accounting equation is still in balance. I earned $640 for service revenue, but the customer has not paid Tiny Town Kennel yet. All right, so this one, let's do the easy part first, the revenue, all right? So I've got my service revenue, which I earned, and in accounting I record it when it happens, and we call this accrual-based accounting, when it happens, not when I get paid for it. So service revenue, which is part of equity, is going to go up by $640. Now, if they paid me right then, the cash would go up and it would look just like the first one. But they haven't paid me yet. So the account that goes to is something called accounts receivable, which is an asset. Remember when I said liabilities always have payable in the name because you have to pay it? Anything with receivable in the name is something that you are going to receive. So we count that as an asset. It's cash that I haven't quite received yet. And so that is an asset, and that is going up. So it's when I receive service revenue, it's either going to be I receive the cash now, and that's an asset, or they owe me the money, and I still count that as an asset. It's just cash I haven't received yet, but it is coming, so I go ahead and count that as an asset. And E, I received a utility bill of $85, which will be paid next month. Okay, so again, we've got a bill here, so this is an expense. So this will be something like utility expense. And again, I record it when it takes place, not when I pay it. So the utility expense is part of equity, and that's an expense, so that goes down. And then the other thing, I owe this money. I haven't paid it yet, so that's a liability, all right? And if I owe this money, it will go to something like something with payable in the name. Utilities payable, or it could even be accounts payable is a common one you see. So the liability is on this side of the equation, right? That's over here. So I can see that equity went down. The liability is the amount that I owe, and the amount that I owe went up. So the liability went up. So you can see here, the liability goes up by 85, the equity goes down by 85. Nothing has happened with the assets, but the accounting equation is still in balance. And the last one here is Maxdale withdrew $1,000 cash. So we know we've got cash involved, and that's an asset. The owner took the cash out, so the business, the cash is reduced, that goes down. And then withdrawals are part of equity, right? And we saw that withdrawals are a negative part of equity. That makes equity go down. And so again, assets goes down and equity goes down by the same amount, and the accounting equation is still in balance. Some of those, some of those account names are very new, and so it'll take a little while, but the more you do it, the easier it gets, and some of these are very common. You see these a lot. Look how many times we had cash in there. But this accounting equation can be broken down. So assets, just the same way we broke equity down into the 4 types of accounts we have in equity, assets can be broken down by all the different asset accounts we have. Liabilities can be broken down by the different liabilities, and it looks more like this. And so we start out, so here's just assets equal liabilities plus owner's equity. but we broke owner's equity down into capital, withdrawals, revenue, and then if I had 15 different expense accounts, they would all be here. Asset, I have 3 different assets right now. And so this is a page in your book, and they would work you through that. But each transaction then I can look at, and this is a way to keep track of them. And so you can see this first one, cash came in, capital came in, and then it looks here like I bought supplies on account. So supplies went up, my debt went up, but they do this each time to make sure that the accounting equation is still in balance. And then it looks like I bought land. And so cash went down, land went up, but then I keep a running total to make sure that the asset side still equals the liabilities and the owner's equity side. And this is an example in your book where they work through each of these transactions and shows you how it affects the accounting equation. But each step, you make sure that this side equals this side right here. And you just keep a running balance in each account. Okay, the last thing I want to talk about is financial statements. And again, I mentioned that we use what's called accrual-based accounting, which means I record actions when they take place, not necessarily when the cash changes hands. So I record expenses when they are incurred, and I record revenue when it's recognized, not when it's paid. And in that way, I am matching up the revenue that was generated with the expenses that were required to create that revenue. What I don't want is to report revenue this month with last month's expenses, because then it's hard for me to measure the profitability. So we really do 4 main financial statements. The first one we always do is the income statement. That shows the revenues and the expenses and the net income for a period of time. So it will be for the year ended such and such, or for the month ended, or for the quarter ended, but it shows all the activities that took place within a set amount of time, and the title of will tell you that amount of time. It also shows us the net income or the net loss, and that net income or loss is given to the owner. And again, everything we do in Accounting 1 is a sole proprietorship. We won't get to partnerships and corporations till Accounting 2. So the second statement is always the statement of owner's equity. And here we're recording what changed. Changes in the capital account over a period of time. Over a period of time. And I'll show you an example of each of these in a second here. And then the third statement that we do is the balance sheet. The balance sheet shows us assets, liabilities, and equity at a point in time. So whereas the income statement and the owner's equity shows us what happened over the course of the year, it summarizes everything that happened over the year. The balance sheet is just a point in time. You can generate it anytime you want, and it shows you, here's what this business has at this point in time. The fourth statement, which we're not really going to talk about right now, is the statement of cash flows. Because we record transactions when they take place, not when the cash takes place, they're not always going to match. And so the statement of cash flows reconciles those differences. For instance, you can be showing a profit on your income statement and you could still have a negative cash flow because I made a lot of sales but I haven't been paid for them yet. And so the statement of cash flows will reconcile the differences in those. They show it to you in your book, but we won't really talk about that till Accounting 2. So let me just kind of show you the statements. We always do the income statement first. So The header gives the name of the business, what the statement is, and again here, say for the month ended, it's a period of time. So, or it'll say for the year ended or something like that. The revenue is always listed first, then we list the expenses. Now in this one we only have a couple, but we indent that, and then here is the total of these two, and then we show the revenue minus the expenses equals the net income. That's a little hard to read because I wrote over it, but revenue minus expenses equals net income. You put a little double line here to show that you're finished, that the calculation is done. On the income statement, revenue or expenses are listed biggest to smallest, but if you have miscellaneous expense, that always comes last, even if it's not the smallest. Then we take this net income and we give it to the owner. So the next statement we do is the statement of owner's equity. It shows what the capital was at the beginning, plus what the owner added in, plus the net income, and then we get a subtotal, then minus what the owner took out will give us the ending capital balance. So we kind of do all the pluses first and then all the minuses. So if that was a loss, it would be down here with the negatives. But it really just shows us what we started with, what changed during this month, and what we ended with. Now we need this number then to show up on our balance sheet. So the balance sheet is here. We have assets on this side, we have liabilities and owner's equity. And that is our accounting equation. Assets equal liabilities plus owner's equity. So the balance sheet really is the accounting equation. So the assets are listed, they're actually listed in order of what's called liquidity. So how fast it can be turned into cash. So cash is always listed first because that's the most liquid asset. Accounts receivable is pretty much always, so liquidity refers to how quickly you could turn it into cash. So accounts receivable are things that you are probably going to get paid in the next 30 days. Land, for example, would be tougher to sell. It would take a lot longer for you to turn that into cash, so it's less liquid, so it goes at the bottom. Accounts payable, here's the capital that we got from the statement of owner's equity that we just did. And so liabilities plus owner's equity, I've got $30,500 there, $30,500 here, and the balance sheet balances. And so it's called a balance sheet. It has to balance. The asset side has to equal the liabilities plus the owner's equity side. If it doesn't, you've got an error somewhere prior to this. So, and again, this is for it just has a date. It doesn't say for the month ended. It just has a date. So as of this date, this is all of our assets, our liabilities, and our owner's equity. So we'll just do a couple of these. I'm not going to try and draw these on here because it would be way too messy and you'd never be able to read it. So we're going to take this data and we're going to generate the statement. So first it wants an income statement. So on the income statement, I need revenue and expenses. And there's really not a lot of guesswork. If it has expense in the name, it's an expense. If it has revenue in the name, it's a revenue. So we've got, here's our service revenue. So I need that one, and then I need anything with expense in the name. So I've got insurance expense, I've got utilities expense, I've got rent expense. Capital is not going to be on this one. I don't need that for now. Cash is an asset. I don't need that. Salaries expense I want. Accounts payable is a liability, so I don't want that. Office supplies is an asset. I don't need that. Withdrawals is part of capital. I don't need that. Accounts receivable is an asset. I don't need that. And equipment is an asset, so I don't need that. So I just need the revenue and 1, 2, 3, 4 expenses. And so the statement would look like this. For the year ended December 31st, here's my one revenue account. My salary, my expenses are listed biggest to smallest. So I've got 1, 2, 3, 4 expenses. The total is $50,500. So I take my revenue minus my expenses and I get a net income of $29,500. So this will then have to go to the statement of owner's equity, which I do next. So what I'll need for the statement of owner's equity, I'll need the beginning capital balance. So this is December 31st, 2016, which means this January 1st is what I had at the beginning of the year. So I'll need that. I'll need any additions to capital or withdrawals. And so I can see I've got a withdrawal here. It doesn't say anything about adding more to capital, but I will also need that net income that I figured on the last page, which is $29,500. So I have the beginning balance, and then I have what went in was the net income, what went out was the withdrawals, and then I can calculate the ending. So here was my beginning balance. There were no owner contributions. Here was the net income, which came from my income statement, which gives me $42,800. Then the owner's withdrawals were $4,500. So I end up with an ending capital balance of $38,300. And I will use this one then on my balance sheet. So the last statement we make is the balance sheet. And again, so I need assets, liabilities, and the equity account. So I don't need expenses or revenues. I don't want to use this one, right? Because this was my beginning capital balance, and I want my ending capital balance, which is the $38,300. $38,300. This is my old one. I don't want to use that. I will need cash. I will need this liability. This is an asset. I've already recorded this. This is an asset, and this is an asset. So I need my assets, my liabilities, and my new equity that I figured out on the statement of owner's equity. Statement of owner's equity. So my balance sheet looks like this. Over here's my asset. I always put cash first. Accounts receivable is pretty much always second. And again, these are just coming right from here. These are the ones I circled. I'm just putting them in order. Office supplies, equipment. And I've got total assets of $42,600. I've got one liability, and then here's my new capital. I put those together, and I've got $42,600. So my balance sheet is in balance. And those problems are all in the demo problems, so you can work those yourself if you want to kind of see how that works. But it is important that you do them in order because some things feed into the others. And the last thing I want to talk about in here is about how I can use these statements then to evaluate the business performance. So the income statement really shows me the profitability of the business, right? The income, the net income, or the net loss. The statement of owner's equity, when I look at that one, that shows me the amount of profit or net income that's being reinvested in the business. So I can see, for example, if the owner's taken everything out, which is making the owner profitable, but maybe not the business. So I can see how much he's putting back into it. The balance sheet shows me the resources that the business has. It also shows me the amount of debt that the business has. And the statement of cash flows, which we didn't really talk about, shows me changes in cash. Changes in cash. And if I'm a potential investor or a potential creditor, like a bank, I would want to look at all of these things. I want to see if this business is making money. I want to see how much that money is being reinvested. I want to see if this business has a lot of debt or if they have a lot of resources. And I want to see that they, for instance, if I'm making a loan to them, I want to make sure they have enough cash to be able to make their payments to me. So we can use data from all of these statements in order to generate a lot of ratios. And so these are very popular in business, and investors use these very, very heavily, which is also one of the reasons it's important that everybody calls things the same thing and everybody records things the same way, so that when I compare these ratios, I am making legitimate and even comparisons. So one of the very common ratios that are used to evaluate business is return on assets. assets. And pretty much every chapter we put in a couple of these so you can kind of see how we do it. Also called ROA. And so the return on assets is the net income, which we get from the income statement, divided by average total assets. And anytime you see average in one of these ratios, you take the beginning number, so what it was on January 1st, plus the ending number, what it was on December 31st, and average the two together. And you really see this a lot in these ratios, so you kind of need the two balance sheets, so the end of last year, the end of this year, to figure out what the average is between the two. But that's how I would do return on assets. And just here's a quick example. Refined Water Services had net income for the month of October of $74,000, so that would be from their income statement, right? Assets at the beginning and end of the month were $350 and $390 respectively. Calculate their return on assets. So the ROA is the net income divided by the average total assets. So I've got the net income was $74,000. The assets at the beginning of the month were $350. At the end of the month were $390. So if I average those two together, I get 74,000 divided by 370. So I get 0.2. So the ROA is 20%. Return on assets of 20%. Is that good or bad? Well, generally that's pretty good, but really these numbers are only meaningful if you compare them to something else. So if I'm in this business, I would want to look at my ROA month after month after month. Is it going up? Is it going down? Am I looking for trends? If I'm a potential investor, I would look at this business's ROA compared to other businesses that I'm considering, or other ones in their same industry, other water service businesses or something like that. And so it's really hard to just look at any of these one number and say this is good, this is bad. Sometimes you get guidelines, but really these numbers are much more meaningful if you're comparing them to something else, either the same business over time or other businesses is what makes the ratios really useful. So there you go, there's chapter 1, and let me know if you have any questions.